Good day, everyone. My name is Matthew Curtin. I'm a senior editor at Scope Group and would like to welcome you to this webinar. Our subject today is the rapid emergence of data centers as a standalone real estate asset class in something like less than a decade. Growth in this subsector is continuing apace. Investors have poured in and yields remain attractive. But what about the risks specific to a real estate segment, which is quite unlike the rest of the industrial and commercial property world? In particular, what are the pressing issues related to sustainability that the sector faces amid rising energy costs and toughening ESG regulations? To answer these questions and more, it is my pleasure to have with us today Rigel Patricia Scheller, who is a corporate ratings analyst at Scope Ratings, who has taken an in-depth look at data centers as part of her coverage of the property sector.
Thanks, Matthew. My pleasure. Great to be here.
Well, Rigel and I are going to have a short discussion of the big themes and then leave some time to answer your questions, which you can enter on screen in the question function in the BrightTalk platform. On the right-hand side of the screen. So to kick off, Rigel, why don't you set the scene? What exactly has been driving this rapid growth in demand for all the buildings that house data centers?
Well, Matthew, I guess this web discussion is a good example. The pandemic and all the lockdown, the restrictions we have seen in the past couple of years has contributed to the surge in data traffic around the world. Whether it's a video call like this, shopping online, the cloud, and other manifestations of our increasingly digitalized economy like cryptocurrencies, all this has driven the creation of data. The volume of the digital data we will create over the next 3 years will be more than that we created over the past 30 years. So look at this figure. It's a very steep curve, isn't it? We got some interesting data from the International Data Corporation, the IDC. So they forecast that data consumption will grow at a 5-year compound annual rate of 26% through 2024 and will reach more than 140 zettabytes. But what is zettabyte? A zettabyte is equivalent to 1 trillion gigabytes of data. So I get lost on the numbers. So it's not a surprise the situation in the European Union, having seen the vacancy rates in Europe's major data centers drop from 11% down to 7% over the last 8 quarters. With that growth, we also have seen pretty impressive growth in the number of data centers too. The number of hyperscale data centers worldwide increased to around 600 at the end of 2020, and it's more than the double since 2015.
That is pretty impressive growth, and I guess it might even prove conservative. Now, I think it's clear that plenty of investors have taken note, haven't they? Which is why we've seen lots of different sorts of investment firms get involved in the sector.
Yes. So we have seen a wide range of investors, increasingly including data centers in their real estate portfolios. A good example are real estate investment trusts, such as Colony Capital, which recently rebranded at Digital Bridge Incorporated, with $30 billion under management focused on digital infrastructure. Institutional investors, sovereign wealth funds, private equity firms, and specialist funds have also invested, often through joint ventures. This segment has had a fast-paced change. Some years ago, it was not seen as an attractive sector. In my own experience as investment manager, data centers were old premises with low rents in worse locations. and with no third-party usability. This partially explains existing yield gaps. The next chart gives you an idea of how data center yields compare with the rest of the real estate sector. Yields are attractive compared with other asset types. Most traditional sectors have trended to historical low yields in past years, with prime office yields going so low as 2 or 3%. And logistics have followed a similar trend, but they still offer some potential, which have been absorbed by the market in the last couple of years. Data center yields, on the other side, range from 5 to 7%, according to information from Savills, depending on the quality of the asset, the location, representing an average of around 1.5 percentage points premium over all other segments. Now, speaking about data centers means operational real estate with relatively low inventories, less tenant turnover, and higher yields in general. But in general, alternative assets are gaining interest. So CBRE investor surveys found that 60% of respondents are actively pursuing one or more alternative sectors, and this is led by data centers and healthcare facilities. But it's not only about yields. Growing interest is also explained by promising stable cash flows. Users of data centers tend to be large corporate clients with strong credit ratings willing to sign long-term leases, 10 years or more on average, and they stick to these leases. Also because reallocation are related to really high cost.
Yes, and of course, I mean, data centers aren't all alike, are they?
Yeah, that's true. So in the 90s, data centers were mostly allocated in logistics and office areas, but the digital transformation of the economy has speeded up. So we need much more specialized premises. Today's tenants and investors are mostly focused on newly built premises with high standards. I prepared one slide regarding the main categories of data centers. We have the more popular, the hyperscale data centers that are large facilities. They're built for companies with massive infrastructure needs. The hyperscale data center operators first built these facilities for large public cloud providers. Another category now more becoming popular, the edge data centers, emerged recently in the data center industry and provide data center services where the end users are. So while growth in larger hyperscale data centers is the most visible trend, these edge data centers might become more popular thanks to newer technologies like the 5G or autonomous driving. Colocation data centers are typically designed for lease out to multiple clients in form of retail leases or wholesale leases to larger companies. These facilities themselves come into a variety of forms, but most can meet a wide range of needs.
Very interesting. In this context, I'd be surprised, though, given that this is an industrial sector growing so fast, if the data center segment didn't bring new challenges and risks for everyone, for property developers, asset managers, operators, and investors.
I would be too. We highlight 3 sector-specific factors that investors need to take into account. So construction cost, location, climate risk, environment, and together the environmental impact and the energy cost of these premises. Let's consider first the construction. Construction costs are relatively high. as data centers require a significant amount of infrastructure support in both hardware and software areas. A fully equipped data center cannot be built for less than 10,000 euros square meter, and a state-of-art center might even double this cost. This is mainly due to the high proportion of technology in a center's construction. It can easily reach 80% of the total manufacturing cost. And there is all of this tech inside. All this equipment that the data centers house has a much shorter useful life than the buildings themselves. Replacement costs can be reflected in correspondingly high maintenance and repair costs. Older premises are hard to sell and hard to rent in today's highly competitive environment, as more built-for-purpose centers with advanced technology and security features are there and more come into the market. Secondly, we have the question of location, which is closely linked to another big issue, all the ESG questions looming over the segment. To a far more important degree than other sorts of properties, data centers need easy and 100% reliable and secure access to power grids. Increasingly, the importance here is not just a question of day-to-day running cost and reliability, as we have seen in the energy crisis Europe is experienced this year. It's also a question of managing risk of running data centers related to the environment. Natural hazards, flooding, storms, high temperatures are important to consider when performing a site evaluation. Managing the impact of the environment that data centers themselves have, particularly as heavy consumers of electricity, power and cooling are really important points. Data centers are energy-intensive buildings, consuming 10 to 15 times the energy per floor space compared to a typical commercial office building. And the energy sector price shock shifted quickly to renewable energies. So the appetite within the sector increased a lot. And that's one of the best ways for a provider to ensure they can fulfill a fixed price lease. So they can get this fixed price lease in combination with a fixed rate agreement from a renewable provider. Then there is no need to eat price hikes or to pass them to clients.
Yes, Rigel. So yeah, the energy consumption is a real issue. In fact, data that you've cited in the past shows that electricity consumption in data centers in the EU will have increased by nearly a fifth between 2018 and 2030, according to the European Commission. That accounts for 3.2% of energy demand in 2030, up from 2.7% in 2018. But of course, energy use is just one side of the equation, isn't there? There are all these sort of energy-related sustainability issues as well.
Yes, sustainability is not only about energy use. There are also wider environmental concerns to be considered there. New data centers are registering for environmental assessments such as BREEAM or LEED. And this is being driven by local planning requirements, corporate requirements for a more sustainable operations, and the rise of colocation data centers, where the requirements for attracting clients can involve more than just providing data rack or power supply. Water is also an increasingly important issue, as well as the conventional requirements for humidification, more efficient cooling strategies, and frequently incorporate evaporation-based cooling. The European Commission also estimates that the ICT sector generated around 2% of the global CO2 emissions in 2020, where the data centers have the faster growing carbon footprint from across the whole ICT sector. data centers use so much energy. They actually present great opportunities to reduce the carbon footprint much more than other building types.
Well, Rico, that's quite sobering, isn't it? Clearly, such high energy use and such high carbon emissions expose a segment to greater climate-related regulation, a challenge that some data centers have started to address. You pointed out to me that Equinix, I think the largest data center co-location provider, has set a target of achieving 100% renewable sourcing and hitting global climate neutrality by 2030. In fact, last year, 91% of its electricity consumption was already from renewable energy sources. Now, bearing all of this in mind, the energy costs, the environmental considerations, what are the credit implications from this mix of circumstances for owners and investors in the data sector subsector?
Okay, we assess credit risk profiles of real estate firms with data centers among their portfolios by looking at the company's business risk profile and the impact in the company's financial risk profile. So first, data centers offer diversification, and such assets have less correlation with traditional real estate property types. Just a second, here I have a summary for that. The COVID-19 crisis demonstrated that data centers are less vulnerable to short-term economic swings. And the asset quality is also increasing in the segment. The companies benefit from a growing proportion of high-standard modern data centers. And as we have said, data centers typically provide with a long-term resilient cash flow profile that supports the company debt protection and even the asset protects the asset values. The relatively lease term signed, long lease term signed, compared with other asset classes, paired with the mostly blue chip nature of tenants that benefit from investment grade credit quality, ensures high visible cash flows. This is a credit positive. And it limits the downside risk in terms of an issuer's interest cover. Furthermore, we believe that, like other real estate classes, the existing yield gap will lead to positive fair value uplift, subsequently reducing an issuer's leverage, given the mostly stable cash flow profile also. This provides owners and operators of data centers with the headroom to finance further growth or investments in their portfolio. The latter is driven by the acceleration of technological change, hence the need to constantly upgrade the portfolio. On the other side, rating constraints stem from relatively high energy consumption of these facilities that is expected to face some scrutiny from regulators, with an increased focus on property stock to reach the target carbon neutrality of the European Union in 2030. This eventually leads to additional capital expenditures to revamp existing stock, and which tenant might not reimburse. This might result on stranded assets, especially for data centers built more than 10 years ago. As you can see in this final slide, this is our view on what a top-tier data center portfolio should include. Matthew, you're on mute, I think.
Thank you, Raquel, for pointing that out. And thank you for such a thorough overview of the sector. While our audience digests that last slide, we've got a couple of questions in, and one of them is on Bitcoin and data mining. I wonder if you might be able to say a few words on the impact that's having on the sector.
Sure. Bitcoin mining requires a specialized high-performance hardware that can solve computational algorithms at a high speed, accurately and efficiently. Some countries around the world support this kind of operations. Russia, Eastern Europe, and China, and lastly the USA. And they even offer energy price subventions for these activities. The demand placed on a facility built and run as a mining operation are somewhat different to those other from hyperscale cloud facilities or enterprise data centers. In this case, reliability is not much an issue. If a mine goes down for a few hours, mana is lost, but the data won't take half of the websites in Europe down alone. On the flip side, density and cooling are much more important. To make this crypto mining operation profitable, you need to be harvesting more cryptocurrencies than you are paying for electricity by a significant margin. As a result, some of the most efficient cooling and hyperdense racks architecture from the past years has originated as a crypto mining solution. Due to the large power draw of mining operations, data center providers have to get creative with how they allocate power in these facilities, as well as looking for alternative sources of power to help bring down overhead. This is a difficult task, which leads many hosting providers simply decided not to accommodate this kind of clients. In fact, data center space for Bitcoin's mining equipment is in such high demand right now that in some instances miners offer bounties for referrals to crypto-friendly data centers. You're on mute.
Very interesting again, Rigel. We've got a question in here which looks this time more at the balance between the makeup of the industry. Do edge data centers threaten the use of hyperscale or co-location data centers, or are they complementary?
They are kind of complementary. The hyperscalers have another kind of demand coming more from the hyperscaler companies, Google and Facebook and other large names. So they have another kind, let's say, of demand, whether the edge center have a different kind of location. So the hyperscalers will go, let's say, a bit far from the main cities centers. So they will look another kind of locations, and the edge data centers will try to be more close to the end user. So let's say the edge data centers have another kind of utilization. They will be more related to this 5G that is coming now, and autonomous driving and Internet of Things. So they will satisfy another kind of demand. So I would say that they are rather not competing, but more complementing the services that both type of assets are offering.
Very good. And with sort of related to that, another question we've come in is looking at Europe specifically. Where are data centers sort of finding themselves concentrated in Europe? Which are the best locations in a European context for them? Where are the operators tending to go at the moment?
Okay, the most until now, so very the most popular markets are the FLAP market, so that is in France and Paris, Frankfurt, London, and Ireland. So and the Netherlands. So we have, let's say, these markets dominating the most of the markets, and the companies prefer to go there because there are all of the new buildings will be built around these areas. That is also connected to the demand from companies that prefer to be close to their data center operations. But there are some other new names that are coming. So for example, one region that is offering good chances is the Nordics, where the reliability for energy supply is, and because the grid is mostly based in renewable energies, and the performance of the grid offer, let's say, a more convenient location. Also, the electricity prices in the Nordics are competitive. So, according to a benchmark prepared by Savills, they are offering these competitive energy prices. Even more, they have strong connectivity, security, and a large pool of cloud users that add attractiveness to this region. So I think if I can mention one more market, so I have heard about new developments in Spain, when some companies are trying not only to create a new area for data centers, but also a very efficient supply there.
Very good, very interesting. So it's interesting that I guess cities like a city like Madrid might be joining Frankfurt, London, Amsterdam, Paris, and Dublin, as you mentioned there, as a new cluster of data centers. We've got a question here going back to environmental regulation, in particular the GDPR, but relating to location within Europe. Do you see the European EU rules affecting the competitiveness of the sector in Europe, and indeed influencing the trend that you just mentioned there, the fact that maybe the Nordics are attracting more investors?
Well, it will be a combination. Yeah, it will be a combination, because when considering the location for data centers, you of course will try to get the best combination of power or energy cost, but also you want to offer security, and that, I think, it's one of the main points when selecting the location, and that is also one reason why until now the demand is concentrated in Europe. So indeed it will impact, but the companies, I think, are evaluating these both points together. So security and energy prices should be combined.
Very good. Well, I think that's been a really thorough overview of the sector. We've had some interesting questions. So it leaves me just to thank you again, Rigel, for taking part, and to thank our audience today. We look forward to having you on Scope Ratings webinars in the future, and leaves us to say goodbye and thank you, and have a good afternoon.
Thank you. Bye.
Thank you. Bye.